Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from ChartsandMarkets.com runs down the major markets. He says stocks are slowly but gradually climbing. He points out the so-called white metals are doing quite well. Ross also checks out gold, crude, the U.S. and Canadian dollars, and has a special offer for our listeners. InsideTrackTrading.com President Eric Hadik explores the cycles connected to war, the Dow Jones, gold, and currencies, including Bitcoin. Founder of the TrendLetter.com, Martin Straith, weighs in on the Trump versus Musk war of words, the U.S. economic outlook, Japanese bonds, and the surge in white metal prices. He also has some very special offers for our listeners to help support men's mental health. Author of the second edition of When the Bubble Bursts, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, checks out the state of Canadian real estate and warns the bubble could be ready to explode. He also looks at the possibility of Alberta splitting from Canada. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from ChartsandMarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Oh, it's a pleasure to be with you, Jim.
Ross, how would you describe what happened on the stock markets this week?
Well, this is another week. We are just grinding slowly higher. You know, it was a week and a half ago. We had that small pullback to just the 20-day moving average, which is where we were anticipating that we would have some support. I mean, this all comes off that real capitulation and high volatility low that we had in the first week of April. So at this point, we're grinding our way up. As we push through that 61% retracement level, that then sort of threw out the window of the retest of a low. And so in this case now, we're just pushing our way up. As of this week, with the employment numbers and all, you've got the S&P/X at a new high for the move. NASDAQ is doing quite well as well. So, you know, I think you continue to grind higher for the next couple of weeks. We could, as we get back to the old highs, see some pretty good resistance. I think the next correction will be a little bit deeper in terms of relative amount than we saw at the latter part of last month. You know, that was the pullback to the 20-day average. I think next time around, it becomes a little deeper, more back towards the 50-day average. That's probably around the same level, but it will have been coming from a higher high. So at this point, trend is up for now, and a deeper correction probably as we get past the middle of this month.
What's going on with gold?
The gold market has, you know, it had its big run. It's just been, you know, quite that, up to just shy of 3,500. Got the deep correction, which we anticipated, and ended up with good oversold springboard signals that, as of the first week in April, and early May. And a good bounce. Now, you typically look for just a 50 to 61% retracement, which is what we've done. We got back to 3,400, and we're just biding our time in here. The mining stocks had been showing good leadership, but they've paused a bit here in the last week and a half. Still thinking that the optimum support for gold will be once we get a good oversold low, probably with the relative strength index down into the mid-30s. And that's going to take a bit of either consolidation here or a deep hard break. So I think as far as the gold is concerned, there's no need to rush into anything right now. Clearly, the leadership within precious metals has moved over to the white metals, silver, platinum, palladium, which had all been consolidating for months. They have broken out, each one of those establishing big upside momentum moves this week. And on the silver, we've been looking at a 5-year cycle that put in its significant low here just a month ago when we were into that hard break where everything got hit into the first week of April. Good bounce from the $28.50 level back to 33 on silver, consolidated and has now broken out. We're at $36 as of today, and I've been watching the weekly RSI as a key indicator to establish the breakout move on the upside. When we're looking back, say each of those 5-year cycles, which when that RSI broke out, that then clearly the move got underway, and this cycle right now would expect to see it run right until the first quarter of next year. Definitely some pauses along the way, but I think initial upside targets, probably first one around 37. Next one would be up at $50 or higher. So lots of potential there. The mining stocks, silver stocks, if you look at things like the SILJ, they have been performing just fantastically this last couple of weeks. And I think, any pause in that sector becomes a buying opportunity. There's lots of potential. And over the years, silver can be one of the most exciting items when it does come to life.
What's happening on the crude market?
Crude is, the whole group there, crude oil, heating oil, natural gas, they are all pushing up against the highs that we've seen in the last couple of months. That $34 or $64 level on crude has been tested, I guess what do we got? 1, 2, 3. This is now the 4th time since it broke. And that had been a key support from September through March. And as we've come now to test that from the lower side, we ought to be watching pretty closely here to see whether it can gain some momentum. We did have some good oversold readings at the bottom, and we've had the initial bounce. I think it's going to have to show resiliency through 64.5 to 65 to put it into a reasonable seasonal uptrend here for the next month or so.
What's happening with the U.S. and Canadian dollars?
U.S. dollar is holding quite well at its previous low. This had bottomed out in April with everything else. The first good rally was back to the 50-day average, which is where you expected to see resistance. The amount and the magnitude of the break into the low in April, unlike other markets which were in uptrends and then corrected into April, the dollar index had been trending down really from the first week of January. And by the time we got into that April, early May low, the indicators were just off the bottom end of the scale. And so the first rally was to be expected, and a retest of that support, which we're now seeing, really becomes critical here. I would think that you ought to be watching pretty closely any rally that fails to get above 100, 100.5. It still puts it into a mode of consolidation with now a downside bias rather than an upside bias.
How's the Canuck buck doing?
Canadian dollar, along with other currencies, has had a pretty darn good week. We're at 73 as of today. Had an oversold springboard reading here 10 days ago down at 71.5. So it's been a nice little uptrend. It is still outperforming the commodity index, the CRB index, and the oil market. So uptrend is in place, and until we see anything in the way of an overbought situation or a divergence relative to the CRB and oil, treat it as an uptrend, and it's not as though it's doing it on its own right now. We're seeing the same things when you look out through things like the euro, which is retesting its highs of the year this week. Same thing over, the Mexican peso. And look at there. I mean, this is the highest level we've seen in about 10, 12 months right now. So there's some strength in currencies relative to the U.S. dollar. On an individual basis, some of them are outperforming, and some are just biding their time, and like the Swiss franc is biding its time right in here. But I think for the Canadian dollar, uptrend in place, but just don't look for anything dramatically on the upside.
Ross, what's going on with Bitcoin?
Well, Bitcoin, we haven't followed it and reported on it too much, but the signals have been pretty clear-cut, so we'll probably add it now to our list of items that we talk about. There were some really good indications of a bottom out both in the February and retest at the first part of April. This rally has managed to go back and make new highs up around 112,000, and at which point we got some good-looking sell signals. And as of this week, the correction from 112,000 back down to 100,000 has come and tested the 50-day moving average, which it likes to do historically. The other thing we've got, as of Thursday's close, was an oversold springboard signal. That's the first one since the moving averages, the 20 and the 50-day moving averages crossed. And so generally, when you get a springboard like that, the first signal is capable of not only going back and retesting the retracement levels at 50 to 60%, but will generally manage to push through to new highs. So I think Bitcoin is one that's got some reasonable potential here in the coming weeks.
Ross, anything else you'd like to add to today's show?
Just a reminder, through the 15th of June, we're doing 50% off new annual subscriptions for anybody who wants to come on board. So drop by the website, chartsandmarkets.com, and there's a link right there on the homepage.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, Eric Hadik. Next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Oh, thanks for having me back, Jim. Pleasure to be with you.
Can you tell us a bit about Inside Track, spelled with two I's, and how our listeners can subscribe?
Yeah, Inside Track is a advisory service and a technical training and trading service that focuses on technical and cyclical analysis of the markets, including the futures markets, stock indexes, foreign currencies, metals, most of your primary speculative and investment markets. And the best way to find out more information, to see a lot of samples and archived materials, and also see the different subscriptions we offer, is to visit our website at www.insidetracktrading.com, and that's inside with the extra I in the middle. So it's INSIIDE tracktrading.com.
With the Russia-Ukraine war, is the war cycle a good predictor of what could be next?
Well, as we've talked about for probably 10 years now, all of my work was saying that late 2021 through late 2025 would be the return of an 80-year cycle of war that dates back to the 1200s and has been remarkably consistent and had its last occurrence in 1941 to 1945, at least from the U.S. perspective. I guess you could say it was about 1938 through 1945 in Europe's perspective. But the thing that I talked about, and I just in my June newsletter, I kind of updated and reiterated one of the principles surrounding that is that often you will see the most dramatic events at the tail end of a cycle. In the markets, I call that my 90-10 rule of cycles, where you often see 90% of a price move in the final 10% of a cycle. But it's also very applicable to geopolitical events, and for obvious reasons, you get a base building in whatever it is you are analyzing, then it starts to accelerate higher, then you go into a parabola, and then it spikes to whatever sort of high or peak of intensity, and then it drops off. And a perfect example is just looking at 1945 and the polar extremes of events, because in one respect, yes, you had the end of World War II, but in another respect, you have to look at what prompted the end of World War II, particularly in Japan. And so you see that you get extreme spike of intensity and then the fall off from that peak. And so that's another reason why 2025 and what I was pinpointing the period between May and August of 2025 would be when you would see that type of acceleration in the cycle and uptick in intensity. And this past weekend's events with Ukraine and the drone attacks on all the Russian airfields have certainly paved the way for that, because you know that there's going to be a response to that, and each time the responses are growing in intensity as well. So that cycle is certainly still in place, still intact, and it has a strong impact on the markets, as I was describing in even in the June newsletter, which is published in the tail end of May. I described how you've got your war cycles and white metal cycles that really entered the intensification phase in April and May, and that was when you had silver, platinum, and palladium all fulfill major cycles and downside or pullback price targets in early April, trigger buy signals right after that. And then they triggered another round of buy signals in early May. And then most recently on May 28th, silver generated a new buy signal that was described in our weekly relay publications. And all of the technical work, and this was published back then, showed that May 30th and June 2nd would time the beginning of an accelerated move up in silver. And that was obviously before anything was known about this Ukrainian drone strike that apparently had been a year and a half in the making. And silver took off exactly during that time frame. And even in that the May 28th and May 30th publications, it described exactly when that parabolic move in silver should culminate. And since then, I've discussed where we could see some important peaks in silver.
The Dow is up by 5,000 to 6,000 points since its April low. Does the Dow look like it's going to new highs?
The Dow has a couple of indicators that says it could retest its highs. As I described to you the last several months and then in all of our March and April publications that the stock markets, all the different stock indexes, and a lot of your key stocks since late 2024, early 2025 had been projecting a minimum of 20 to 30% declines, and with many of those key stocks, 30 to 50% declines over a 3 to 6 month period, and that was pinpointed as likely bottoming in early April. And again, these are things that were written and published weeks and months before the fact, so it's not a case of 2020 hindsight right now. This is what was laid out for our subscribers time and time again. Keep looking for that move to accelerate lower into early April, and even pinpointed a 3-day period of April 3rd, 4th, and 7th as being the time when a major bottom should take hold. You saw the Liberation Day of April 2nd drive the markets sharply lower. So many of them fulfilled the 20 to 30% decline objective, and most of your Magnificent Seven stocks and some closely correlated ones saw anywhere between 30 to 50. Actually, there were some up in the 60% drop from their 2024 or early 2025 highs. So it was a perfect validation of that 17-year cycle and a lot of the corroborating technicals that were laid out in our publications. And the way that the Dow bottomed at that point, it was telling me that there was a decent chance it could go back up and retest its highs. The NASDAQ 100 made an even stronger case for retesting its highs. Some of the other indexes, like the S&P Midcap and the Dow Transports, were saying, no, we should only rebound to a lower high. But the timing for that is what's really important now. We're here in the first few days of June, and the timing for that upswing was identified as likely peaking in the middle of June. The days with the greatest synergy of daily, weekly, and monthly cycles are June 13th and 16th, but there are many weekly cycles coming into play that start even now, right around June 4th, 5th, and extend in a little bit past mid-month. So any point in this time frame, you could see a multi-week and possibly multi-month top take hold. So it's a case of both price action and timing action needing to clarify exactly when and where we can expect a peak in the stock indexes.
Gold is showing some renewed strength. Where is gold in its cycle?
Gold is not as bullish in the near term as silver is. Gold fulfilled just a myriad of cycles and upside objectives in late April, and it would take me too long to list them all, but your listeners can see them in some of our publications. But it was all showing that gold should see a final rally into the second half of April, and then a multi-month high would likely take hold at that time. Multi-month can just be a 1 to 2 month, often is just 1 to 2 months, but we've already kind of fulfilled that threshold. And my work in gold is showing that we still have some consolidation right now, even as silver is projected to surge into through the first half of June. And so you've got this little bit of a changing of the guard, and that's why back in late March I described platinum as being, it was a little bit of a play on words, but pretty transparent too, but being the golden opportunity for 2025, that platinum and palladium should have seen their combination of technical indicators turn bullish, and what was pinpointed at that time was the week of April 7th to the 11th was when those metals and silver should enter a very bullish phase, even as gold was kind of going through this topping phase. So you'll see them directionally move similar, but the magnitude of those moves is significantly different. So you'll get gold bouncing within its trading range, even as silver and platinum are surging to new highs and further validating what's been projected for the rest of 2025 and even into some key cycles in 2026.
Does the silver cycle show new highs around the corner or a top in here?
Oh, it absolutely shows new highs, both in the very near term, in the intermediate term, and in the longer term. When we just kind of shot up to back up to that $34 range, silver was reinforcing the buy signal from May 28th to 29th, and it was showing that at a minimum it should run up to $36 in this short time frame, and there's even a more extreme upside target that I just described why and how this was lining up in my weekly relay alert yesterday, the June 4th alert. And all that to say is, yes, I definitely think silver has more upside in it, and depending on how and when the next objectives are met, that should give some strong clues as to how long a top should take hold and when and where we're likely to see the next wave up.
Does the gold-silver ratio have a cycle?
It does. It's not as strong, and I don't really watch it that close because I really want to focus on each market independently and just focus my not only my analysis, my conclusions, my trading strategies. And when you start to enter correlations in there, you might be right, but yet it kind of hamstrings you with how you're approaching each market. So it definitely has a broader cycle, and that's certainly factors into why I thought that April 2025 would start a big shift in that, where you would see the white metals, silver in particular, since we're talking about gold-silver ratio, but start to take the lead and enter their own bull markets, even as gold is culminating its several levels of its bull market. I still think there is higher highs in the future for gold, but I think that it's going to be something that's a little more labored, even as silver, platinum, and palladium start to accelerate higher.
Is the U.S. dollar looking bullish or bearish?
I still contend that the dollar, let me step back, coming into 2025, my overall outlook was for the dollar index to peak in January, to head sharply lower in first quarter and second quarter, and probably to stretch an overall decline into November of 2025. So from that perspective, I think the dollar is still very bearish. From an intermediate perspective, the midpoint of that January to November down cycle is right now, and early June is when I think you could see an initial low in the dollar index, but that would be just to really enter a trading range for a couple of months where you'd probably see a decent rebound, but we haven't quite signaled that a bottom is intact yet, so there still is the risk of an additional spike low before that bottom takes hold.
The Canadian dollar continues to move higher. Where is the Canadian dollar in its cycle?
You know, I described a little bit of that in my June Inside Track newsletter, but the Canadian dollar had fulfilled some 3 to 6 month upside objectives, and so it could be entering a bit of a trading range or consolidation phase itself. And not only did you have cycles saying that, and several timing indicators. Sometimes I use the term cycles as a bit of a catch-all, but there's a lot of technical indicators that are based primarily on timing, but they're not something that you would necessarily identify as a cycle per se. But a lot of those timing indicators saying that we could see a final spike high in the opening days of June, and that would also complete a likely fifth wave of a five-wave advance that the Canadian dollar has seen since early February. And that would probably usher in a multi-week correction that the first downside target would be around 71.80 on the, I'm looking at the September futures, but basically the low of May is what in Elliott wave terms is the fourth wave of lesser degree. It's where that low was set before the fifth wave advance took hold, and that becomes a critical support zone as well as a downside target for the ensuing correction once that fifth wave has peaked. And so I think that's where we are. Maybe there's a little more upside, but I think that the Canadian dollar has expended most of its upside momentum and energy for now. But the fact that that has been a five-wave advance as well as longer-term cycles is a positive factor looking forward, because in Elliott wave terminology, and I use Elliott wave as a general backdrop, but I don't put too much emphasis on it other than just a kind of a foundation to build on. But when you have five waves in a move, that tells you it's in the direction of a larger overall trend. So you would probably see an ABC correction, something where you get an initial decline, then a bounce to a lower high, then a second decline. That's your ABC to the downside, and then see that Canadian dollar embark on another five-wave advance from there. There are some key cycles that I'm going to be watching, but I haven't really elaborated on them a lot yet, so I'm going to be publishing that first before I go in detail about discussing that.
What's the cycle showing for crude oil?
Crude oil has been showing that we are in a corrective bounce, and that there's a chance, depending on the price action of this first week of June, that it could confirm a 2 to 3 month low. And if that's the case, crude would then project another leg up into late June, possibly stretching into July. So kind of on an intermediate basis, I think that crude is looking more constructive, but it definitely has to provide a couple of confirming indicators and signals as we come into the end of the week. The June 6th weekly close, will be a critical one on several of my indicators.
Does the crude gold oil ratio have a cycle?
If it does, I couldn't really tell you, because that's starting to get too many variables for me to really focus that long on. You get inflationary arguments about that, and yet when you do have inflationary cycles, it really depends on where in the inflationary cycle you are, what impact it has on each of those markets, because it's not only inflation, but it's the threat of higher interest rates, and that has a suppressing effect on those markets during certain phases of the cycle. It's what is triggering the inflation. Is it more a monetary thing? Is it more a commodity supply-demand thing? And so there's so many variables that by the time you get down to whatever that cycle might be, theoretically, it's not something I can use practically for trading the markets. And that's where my focus is, and that's where I try to keep the focus of my analysis and my publications too. Not just theorizing about some general cycles, but how can they be taken to a practical and pragmatic step and used for trading the markets.
Bitcoin hit new all-time highs in May. Where does the Bitcoin cycle go from here?
I have been saying since early March that Bitcoin, and to a lesser extent some of the other cryptos, should rally into May, and that May was the most likely time for a new multi-month peak That's based on a very consistent 10-month cycle that you've seen in Bitcoin over the last few years. And with that, there were several technical indicators that I described back then why it was showing that Bitcoin should rally to new highs, and my upside targets based on both waves and monthly indicators was all saying that Bitcoin should shoot up to about 112,000 to 115,000 and peak at that level, even as Ether and many of your other cryptos would just rebound to your typical or textbook rebound targets. And that's actually what Ether did very recently, rebounding 50% of its decline, giving a weekly trend signal. That's one of my key indicators that showed the rally is probably coming to a close. And the first week of June is when I thought and think that you're going to see the first significant drop in Bitcoin and some of the other cryptos, more so the first half of June. But I think we'll see it triggered and starting to confirm before the end of the first week here.
What's the latest on cycles for interest rates in the bond market?
They continue to show that bonds are in a very broad trading range and congestion phase, but I think that bonds should see a rally into July, and depending on the extent of that rally, that could set a 1 to 2 month peak. If we get a decent run up here in the month of June, that would likely usher in another consolidation phase. But there is one or two convergence of cycles that I'm looking at out in early 2026 that could end up being as noteworthy as these cycles in July, August of this year. But for now, I'd say that bonds are certainly showing signs of a bottom. And so maybe we've got some sort of interest rate related surprise coming in June, whether that be economic numbers, whether that be a rate cut or the assumption of a rate cut. But I do think that you could see bonds see a bit of a rally in the month of June.
Does the inflation cycle follow the real rate of inflation?
Well, when I'm looking at inflation cycles, inflation indicators, I'm zeroed in on, or I'm focused on commodity inflation. So I'm looking at things like the Goldman Sachs Commodity Index, the GSCI, and several of the key leading commodity prices that I follow. And that isn't always moving in perfect lockstep with your economic inflation numbers. So there certainly is some leeway or disparity between the two at different times. But if you've got a truly inflationary cycle underway in commodities, it's going to show up in the economic numbers, and same thing from a deflationary perspective.
Even though it's relatively new, does the lithium ETF LIT have a cycle?
I don't have a strong conviction on lithium other than it continues to be in a bear market. There's certainly some of the lithium stocks that I'll take a look at from time to time just to get a broader sense, and some of them are showing signs of a bottom, but I don't really have a strong conviction on the LIT ETF cycle.
Do home prices have a cycle?
They certainly do, but it's one of those things where there are so many variables, and all you have to do is look at different regions of the country as far as the U.S., different regions around the world to see that that is either such a general or such a specific cycle, depending on which way you're applying it, that it's hard to really make any accurate assessments and prognostications where that is concerned, other than from a very general standpoint. And I did talk about in months past how things like the home affordability index and some related cycles of extreme home costs were peaking about a year ago, but a downturn in any market often occurs quite a ways after that peak. There needs to be an entire topping process before you get an actual significant or substantial move down. But I do think we're on the other side of a home price peak. It's just that it's a slow moving process. And, even if you look back at the last phase in the mid to late 2000s, you had a lot of real estate indexes and home prices peak in about 2006. But then you had the stock market continue up to late 2007. Then you had things kind of going through their own consolidation phase in early 2008. Then you had some of the shoes start to drop in the latter part of 2008, and that's when things in home prices really started to take a hit. And even though the market bottomed in late 2008 in some indexes and in March of 2009 in the majority of indexes, the home prices in real estate continued to go down for anywhere from 1 year in your stronger markets to 2 to 3, even 4 to 5 years in some of your weaker and slower to recover markets. So you kind of see something a little similar to that, and part of the analysis that I detailed over a year ago was that you have this 17-year cycle that is prevalent in so many different markets, so many different geopolitical factors, and that even in real estate, it appears that you've got something similar. And so we're starting to approach the more vulnerable phase of that 17-year cycle in late 2025 and then into 2026. But again, that is just a very general standpoint approach to real estate, and depending on the regions and other factors, the level of where on the continuum that downturn could be seen. There's a lot of other factors that need to be calculated into that.
June 11th, there's a full moon called a strawberry moon. How are the moon or lunar cycles looking?
They look like about every 29 days you can count on a new full moon. And other than that, I can't really tell you because, the moon's always up there and it's always having a gravitational effect on the Earth. And the level of change leading into a full moon is often pretty nominal on a percentage or proportional basis. And it's come to the fact where I think just about every month has a new name for its full moon. So I have to admit I was ignorant as to the strawberry moon until just now. But every month now they have some new, it's kind of like greeting cards where, they got to come out with a new specialty day to sell greeting cards every month. And I'm not sure if or maybe they've been around all along and I'm just revealing a little of my ignorance where the lunar cycles are concerned. But I followed them in the past to see if there was much of a correlation to market action. And even when you talked about your lunar and solar eclipses, it just wasn't practical or pragmatic enough for me to factor it into my work. So it's something that I really couldn't answer intelligently about that.
Where can listeners subscribe to Inside Track with Two Eyes?
Best place is at our website, InsideTrackTrading.com, and that is inside spelled with the two I's, so it's INSIIDE, tracktrading.com.
Eric, thank you so much for being on This Week in Money.
Thanks for having me, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. Coming up, Martin Straith, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News Online of thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money.
Oh, thank you, Jim. It's always a pleasure chatting with you.
June's Mental Health Month. You're offering our listeners some great special offers of 33 to 57% off regular prices in support of Heads Up Guys. Can you tell our listeners about that?
Yeah. So as you say, it's Mental Health Month, and Heads Up Guys is launching their Step Up for Him campaign. We're in the investment world, but we've supported these guys, help them raise some money at the World Outlet Conference. And as investors, if you want to be a successful investor, you have to have a clear mind when you're navigating the markets. And so obviously mental health is a real bedrock of strong decision making. And I'm not talking about just finance or investing, but in life. But for men, the stigma of silence, that can be really dangerous. And this is 2025. So this is really, hopefully men out there are listening that there's help out there. There's a lot of help out there. And what Heads Up Guys, what they're offering is free, practical tools to help men manage depression and other mental health challenges. Their site's got many tools, including they've got this self-check, which so far already 500,000 men have been using. It's helped, and it's helped many more, connect with support. So it was, Heads Up Guys was founded 10 years ago by Dr. John Agrodnichuk. So John's, he's a UBC professor. He's director of the psychotherapy program at UBC. And, what John told me was that for men, the two main issues are, especially for those who are older, are loneliness and a loss of a sense of purpose. So if any of your listeners, need some help, or they know someone who could use some help, go to Heads Up Guys, so that's all one word, headsupguys.org. And if you can help support the Step Up for Him campaign, again, just go to headsupguys.org. So in order to help support them, Jim, what we're doing is, as you say, we're offering your listeners 33 to 57% off our regular prices. And for any new subscription, if anybody signs up this week, we will donate $100 for any new subscription, and we'll donate that to Heads Up Guys. To get those special offers, just go to thetrendletter.com. So it's all one word, The Trend Letter. And just click on, there's a big red special banner up there. It's a great cause, and hopefully your listeners can help and give them some support.
Now, getting down to business, when Elon Musk was appointed to lead Doge, you said he would likely get frustrated after a few months and leave. Well, after his rants calling Trump's big, beautiful tax bill a disgusting abomination, it looks like he's frustrated. What's your take on this, Trump versus Musk?
Yeah, that's been quite the show this week, isn't it? Back when we were talking about it, when I said that, I just said that, there's two of the biggest egos on this planet, and I just couldn't imagine that could last very long. But this show that happened this week, I don't know, you see, to me, it just seemed like it was like a Netflix reality series or something. And, and the skeptic in me kind of wonders if this wasn't all like a social media promotion or something. They both own a social media platform, and they're doing this public tit-for-tat shouting match. And you got, Musk on, and you've got 200 and some odd million of his Twitter people. and you got Trump on his True Social. So I don't know. It seems kind of staged to me, but maybe I've just become too skeptical. But one thing for sure, the stock market, it didn't like all that noise originally. The Tesla stock was down 14% yesterday, although it's up today about 5%. But I know a lot of people that they don't like Musk, and they don't like how he's used his wealth to participate in politics. But the very core of that whole Doge thing was, I think there's some good points here. You could certainly question how he implemented some of his cuts, but the base goal of eliminating massive government waste, it's a sound thing, and it's something that certainly in Canada we got this problem as well. We've got all these governments. It doesn't matter whoever's in power. All they want to do is spend. So here we got, Musk claim that that new bill, it totally contradicts all the Doge efforts to cut wasteful spending. And, his claim is going to increase the deficit by $2.5 trillion. Now, he made all these claims that Doge was going to, reduce the deficit by a whole bunch, and that hasn't really happened. But, if you look at the increase, even the Congressional Budget Office, so that's an independent U.S. government office, they project that new bill is going to add $2.4 to $3.8 trillion to the deficit over the next 10 years. So, the other big complaint that Musk had, and we always see this, is that pork spending. That bill was over 1,000 pages, and there was, after the voting was done, a lot of these Republicans admitted they never had a chance to read through it all. And so all of these provisions were in it, the things they didn't even know about. And this is so typical of government, where the bureaucrats stuff in all these little pieces. And this is where all this government waste gets to, where they create all these little programs and provisions, and it's just for political gain. In the U.S., when they first announced the Doge thing, I was hopeful, but as I said back then, very skeptical that they would, get some meaningful change that could result in the end of wasteful government spending. And now Musk has left, that Doge group will probably just, be abandoned. And now you're left in the U.S. You've got a national debt of $36.9 trillion. That equals $107,850 per person and $323,000 per taxpayer. Here in Canada, the numbers aren't as big, but the problem of massive government deficits and debt it's exactly the same.
There was an adage, sell in May and go away, suggesting October is a weak period for stocks, but this May was the best one in 30 years. What do you see for the stock market going forward? Yeah,
that's true. Like I say, it used to be that, from May to October, it's the weakest season. But, I think that with AI, more and more taking over how things are done, as investors, we need to understand that this applies to how stocks are traded as well. Old patterns don't seem to be having the same impact that they used to. These AI algorithms, they're executing trades. They're executing at speeds and volumes far beyond human capacity. So they can analyze vast amounts of real-time data, including financial statements, news, and yes, social media sentiment. So that whole, Trump-Musk thing that went on the last couple of days, the AI algorithms were reacting to that. And they predict, price movements, and they react instantly to that new information. So as we just discussed, the markets absorb that that whole media circus from Trump and Musk. But after a few minutes, really, that spike jumped up and the markets went down, and then it just reversed. And basically at the end of it, none of that showed up in the price action. So despite the noise, the volatility declined, and the bulls are still in control. So where we are now, I think that favors, higher equity, precious metal, and crypto prices. Right now, we got the S&P 500 testing it, our model's near-term resistance back when it was running 4,800 was 5,995 to 6,015. Well, we're right there right now. Just looking at it here, we're at 6,004. So we've seen the VIX volatility fall, from almost 60 all the way back into the mid-teens. So that's suggesting calmness. We're seeing the fear and greed index is at a mid to low greed level, so that's not overextended. Now, the put-call ratio, I mean, these are all different indicators that our models look at. It is low, so that means that investors are not buying puts, which means they're not buying insurance. So as a contrarian basis, that does tell us to sit up and take notice, because maybe it's starting to say that the investors are getting too complacent here. The bottom line, though, the markets are remaining really resilient here. Now, what could change that? Well, certainly war could change that. Definitely not liking all the escalation in Ukraine and Russia. We've got Iran. If they continue to be defiant on their nuclear weapons, does the U.S. take action? But, for now, the bulls are in control. The trend is up. And again, we're called the trend letter. We follow trends. When the trend breaks, then we react. But right now, the trend is still up.
Japanese bond yields have been rising, and the market is nervous about the yen carry trade unraveling. Can you explain this to our listeners?
Yeah. I'm sure we probably talked about this before, but yeah, here's a simple example. So let's say back in March 2023. So an investor could borrow the yen in Japan at an incredibly low interest rate. Back then, the interest rate was 0.2%. They could then take that borrowed yen and convert it into U.S. dollars. And then with those dollars, what they could do is buy higher yielding U.S. assets. So most common was buy U.S. stocks or buy U.S. bonds. And at the time, so back in March 23, U.S. 10-year was trading, it was paying about 3.75%. So instantly that Japanese or anybody investor who borrowed the yen at 0.2% could be getting 3.75% on the bond yield. So that was just something that they could do. Now, if they invested that money in the U.S. stock market, like if they just invested in the S&P 500 back then, and they were to sell it today, they'd be sitting on an 80% gain. So the problem is, what happens if the Japanese yields keep rising? And that's what's been happening now. So that means that borrowing yen becomes more expensive because the Japanese interest rates go up. And that means that the profit from this trade, so if you wanted to do that trade today, you can't borrow it at 0.2%. I think they're at about 3% now. So that gap between the U.S. bond and the Japanese bond is much, much smaller now. So that profit potential is shrinking. And so many investors are going to start to unwind those positions. So a Japanese bond yield rising, the return on the Japanese bond gets closer to the U.S. bond, and that makes the Japanese investment more attractive for the local. So as a result, we're seeing, and we have been seeing, Japanese investors are starting selling their U.S. stocks and their bonds, and they're moving the money back home, and that's strengthening the yen and putting downward pressure on U.S. markets. So if this repatriation continues, that could cause sharp drops in the U.S. stocks, definitely in the U.S. bond prices, which would increase the yields and increase volatility in global markets. So that's why the markets generally get real nervous. This happened back in August, and we saw the markets crash. So we'll see if this continues. And then, we got to remember this other piece. We've got the trade wars. So we've got rising global tensions. That adds another incentive for the Japanese investors to support the domestic markets instead of, sending the money abroad to the U.S. And so that, bringing the money home, that accelerates the shift back to the Japanese assets. I hope that makes sense.
The Bank of Canada held rates steady. The European Central Bank cut rates to 2%. What do you think the Fed will do at their June 18th meeting?
Yeah, it's interesting. You got Trump yelling at the Fed to cut rates, and the Fed saying we're going to just do it based on data. Earlier this week, we saw the U.S. jobless data come out, and that was the jobless claims were rising. So that goes, the jobless claims are rising. That means, the Fed may have to cut. But then this morning, we had the non-farm payroll come in stronger than expected. So it came in at 139,000 versus the expected of 126,000. So So all of a sudden, a lot more jobs were created. Now, to me, these headline numbers are really a bunch of noise. These numbers always get revised, usually down, but those revisions never make the headlines. So we get this headline reaction. The markets jump around, making all these assumptions, and then, the next month they'll revise them down, but you don't even hear about it. Now, when I just take a look here, now, just as they've announced those up, 139 versus 126, so that's good. But then at the same time, hidden deep into the report, the March numbers were revised down 65,000. So last month, it said that they had 185,000 new jobs. Well, now they dropped it down to 120,000. Well, that's a 35% revision lower. They also revised the April numbers down 30,000 from 176,000 to 147. So that's 17% lower. So while this 139,000 new jobs sounds okay, what happens next month? Do they get revised down 30, 40, 50%? So I honestly don't understand why the markets put so much stock in these numbers, but while we don't pay much attention to them, the markets do, so we have to keep an eye on that. So as far as rate cuts go, as you said, the Bank of Canada held steady. The ECB cut their rates down to 2%. So the markets are now looking for the Fed to cut in September. Bonds were rising in price, but open interest, so that's the number of outstanding contracts, is falling. And that usually means that the rally is being driven by traders closing out positions, not new investors jumping in. And that combination generally signals a weaker or less substantial move. So today, we have a stronger U.S. jobs report. Then the bonds are selling off, meaning the yields are rising, and that indicates the economy is doing okay. And so there's no need for the Fed to cut right now. So I'm just looking at here the Fed, CME Fed Watch. So right now for the June 18th Fed meeting, there's only a 2.6% chance that the Fed would cut rates. So meaning there's a 97.4% chance that they don't. Now, Bloomberg, just read this morning. They're reporting that the markets are fully priced in for a Fed cut in September, especially, like you had mentioned, Europe, the ECB cut rates down to 2% this week. U.S. jobless claims earlier came in softer, so that's a little bit more dovish, so that's supportive more of a cut, not in June, not in July or August, but more likely in September. Now, in all this stuff, we're not hardly hearing the word recession anymore. So the narrative remains mainly on easier monetary policy, softer, soft landing, and not an economic contraction. So overall, the sentiment is shifting toward optimism about a rate cut, but not until September. And then that would be continued support for the markets. But again, that falling open interest in bonds, that tells me that the investors should be really cautious here about the strength of that bond market, because if the bonds start selling off, then that just means yields will start rising, and that really starts to change the picture. And it tells you that the bond market is not trusting the economy. So it may not be as robust as it looks if new buyers aren't coming in. And as I say, today the bonds are selling off.
What do you see ahead for the U.S. and Canadian dollars?
Well, I know I always repeat myself, but whenever you're looking at global currencies, they're all connected, and it's all driven by what happens to the U.S. dollar. So if the dollar rises, other currencies decline. If the dollar declines, the other currencies tend to rise. Now, in the bigger picture, we've got these trade wars. We've got this whole, sell America kind of thing going on with, we got many large, institutions and foreign pension plans. They've been selling some of the U.S. assets and looking to support the more domestic ones. So that means, they sell the assets, they convert those U.S. dollars back into their local currencies. Well, that pushes the value of the U.S. dollar down. And that's certainly what we've been seeing. Now, that kind of took us into into late April. That's when we saw kind of the low in the U.S. dollar. Then it kind of rallied through May into the middle of May, but it's been kind of since since mid-May, the U.S. dollar has been kind of trending back down. Now, right now, it's just tested its recent support level, just around 99, 98. Actually, it's about 98.9. Right now, it's just trading about 99.3 here. is having a bit of a rally the last couple of days. But, right now, the U.S. dollar has certainly been trending down. It's getting oversold. So, we could certainly see a bit of a rally there soon. Now, if you look at the Canadian, I'm sure everybody in Canada would remember that back in February, the Canadian dollar dropped to, almost 68 cents, which was a 23-year low. Now, since then, with all the tariff noise and the U.S. dollar tanking that sell America theme, the Canadian dollar has been up, it's up over 73 cents this week. So the Canadian dollar strength is primarily related to the U.S. dollar weakness. I mean, as I said earlier, the U.S. dollar is weak, other currencies get strong. But also we had a stronger than expected GDP number. And we had the Bank of Canada, as you mentioned, it held the rate steady at 2.75, while the ECB dropped theirs to 2%. So that makes the Canadian bonds more attractive to a European investor. So, they could get 2% on the ECB stuff, or they get 2.75 for Canadian. So all that kind of helps the Canadian dollar. Next support for the Canadian would be 72, and ultimately I see it's going to go down to 70 and probably lower than that, but that's going to have to work itself out. So as I say, Jim, it's all connected, heavily driven by what happens to the U.S. dollar.
Silver had a really big week. What's your take on precious metals?
Yeah, the whole precious metal sector has been doing really well here. Gold just hit an all-time high, intraday high at 3,500 back in April 22nd, and it's been consolidating, trading in a bullish wedge pattern ever since then. It just broke out of that pattern this week, so that's usually a signal for higher prices ahead. We got Goldman Sachs. They just came out with a report saying central banks are buying about 80 tons of gold per month. And those purchases have been driven mainly, or certainly led by China, and that's probably going to continue. So that should keep driving prices even higher. Now, based on seasonality, June is not a good month for gold, so we could see some sideways action over the next month here. But then July into September, that's usually a very strong month or period for gold. So why would gold, do well here? Again, we've got the central bank buying. They're doing that. Why? To protect against currency drop and global uncertainty. We've got government spending way more than they take in, so they're piling up massive deficits, massive debts. That makes gold more appealing as a safe place, to hold value and to protect, purchasing power. You got global tensions rising. We talked a bit earlier, we're in some pretty uncertain times here. You got, Ukraine, Russia, escalating things. You got Iran kind of, pushing off on the U.S. for the nuclear stuff. You got China and Taiwan. So all of that, that offers gold as a safe haven play. And then just based on technicals, we look at technicals. That's basically how we trade. We certainly look at we listen to the news and all that. But we watch what the market's doing. And right now, it's showing strong momentum, gold breaking past key levels that it hasn't passed in years. And then, very simply, the rise in gold isn't just about chart patterns. It's backed up by real-world risk share, economic concerns, and all of that, to me, that's going to push gold higher. We could use a consolidation, a nice pullback. Gold was down about $25 when I last looked. But as long as it stays above that bullish wedge pattern that we talked about a bit earlier, the trend is up. And I think we're going to see gold 4,000, 5,000 over the next couple of years. I forgot that I should mention silver. Silver has really been very hot here, making new highs. Traded at 36.15 right now. It had a year high of 36.51. I mean, we haven't seen that level for 13 years. So we're going back to 2012. So if the price goes above that high, that will be very interesting because that means that everybody who has bet, the price of silver to fall, so we're talking the short sellers, that means that they're losing money on those positions. And when short sellers are losing, they have to add more money to their accounts to cover potential losses. And if their exchange raises their margin, so that's the amount that the money traders have to keep in their account to hold their position, it becomes harder and harder for traders who are already losing money, so that's called the weak side, to keep their bets open. So what that means, if the price makes a new high and the exchange raises margin requirements, that puts extra financial pressure on traders who bet the price to go down. And some of those are going to be forced to close their trade. And that will cause even more product, price movement. I mean, it's called the short squeeze. So for silver, you really watch that. If we hit around 37, that could see a real pop at that point. So key resistance is $37. Really keep an eye on that. Now, the other one that we really want to take comment on is platinum. Platinum had a huge spike yesterday. It was up almost 5% on the day. That's the highest level it's been at since 2022. We've got projected supply shortages for this year, so that was a key fuel for the rise. The World Platinum Council, they're projecting global supplies are going to contract by 4%. So overall, we're seeing broader bullish trends for all the precious metals. We're talking gold, silver, platinum, and even palladium. So they're all gaining as safe haven plays. With all the geopolitical tensions, we talked about Ukraine, Russia, U.S., Iran, China, Taiwan. Again, they give protection for the loss of purchasing power with all the government deficits and debts. So, Jim, I think, we're seeing a real trend here, and the precious metals are doing very well.
Copper's been quite volatile with all the tariffs on and off again. What do you see for copper ahead?
Yeah, well, there's a lot of talk about copper inventories at the London Metal Exchange, and that the supply tightening and some major producers are having trouble with supply. Now, you have to understand that the copper market can be really unpredictable. It's almost like a game of, like a 3-card Monte, where sometimes what you see isn't the full story. But if the copper inventories keep dropping and the prices keep, hitting newer highs at the same time, well, that certainly gives a strong sign that the shortage is real, and that gives validity to this whole market story. So there's this long-running debate. Will copper finally see real shortages because of aging mines, or will the demand from AI data centers drive the prices higher? Both stories have some truth to them, and now could be a really good time to consider investing into the copper. Depending on your outlook, we're still, for us, we're still a little concerned on the trade war stuff. But once we get through all that, long-term copper is really needed for everything. So recent forecasts show copper prices have been volatile, but they're expected to remain high. And we've seen some predictions, for record prices this year. And as I say, we like copper long-term.
What about energy?
Well, if it was just about supply and demand right now, oil would be much lower, probably in the low 50s, I would say. But we have a lot of geopolitical things happen. We've been talking about them. Just this week, Iran has accused the International Atomic Energy Agency, so that's a UN watchdog. They accuse them of slander, presenting sloppy evidence, and escalating tensions just ahead of these key meetings in Vienna. And we've got Western countries, they're preparing to submit a resolution declaring Iran non-compliant with its nuclear safeguard obligations. And that'd be the first time they actually come up with a resolution for all of these Western countries in 20 years. So Iran, in real world, Iran has manufactured record volume of enriched uranium. And it's just below the levels the grade needed for nuclear weapons. And it's not just Trump who's pissed off about this. You've got a lot of countries, certainly in Europe, in the Middle East, that are very concerned about this. So I wouldn't say that the longs, have control of the oil market right now, but right now they've got the upper hand at the top of this range. There's going to be some real price swings here, depending on what Iran does. If Iran goes rogue, or if they succumb to a better deal. And if they go rogue, we're going to see prices, go up. If they go the other way, we're going to see them go down. So it's all about the escalation. We got escalation. Ukraine, Russia is going to be big. So the facts of this: you've got declining demand in China. You've got soft economic data in the U.S., Europe, and Canada. Supply is not excessive, but it is on the high side. So all of that suggests the price should be much lower. But we've got these geopolitical items that are just keeping the price elevated right now. Based on seasonality, oil is typically strong in June, so we could see it kind of move up this month. But July through September is a weak period for oil. So right now, we've been seeing oil trading between around $55 and $66. Today, it's at $64.75. So if it can push through 66 and hold above 67, then $70 is possible. But if the geopolitical tensions calm, watch for oil to drop down, like I say, below 60 and probably into the mid to low 50s or so. Now, another big key for energy, the one that we're really watching, and we've been big on for a long time, is uranium. The price rose to $72 this week, so that's a near 3-month high after rebounding from an 18-month low back in March. So this is all driven by increased political support for nuclear energy. We're starting to see that everywhere. Germany even, where they shut down all their nuclear plants. Now they've basically changed their mind. Uncertainty over future tariffs on uranium imports from Canada. So, right now they've got 10% on Canadian uranium, and Kazakhstan, that's 27%. So that's adding pressure to the limited U.S. domestic uranium capacity. U.S. relies heavily on imports from Canada and Kazakhstan, and those tariffs are adding to the price. Now, also, this week we saw Meta, Facebook, signed a 20-year agreement to purchase nuclear power from Constellation Energy starting in 2027. So this is the first direct nuclear power agreement that reflects broader trend of the big tech. These companies are securing now nuclear energy for growing data centers and AI power. We saw that all kind of change back when DeepSeek came on board, and all of a sudden, we don't need power anymore. Well, that's obviously changed back again. So this move from Meta, it just contradicts the suggestions that big tech is pulling back from nuclear. Instead, it's highlighting the increasing long-term corporate commitment to nuclear as a reliable, carbon-free energy source. We are big believers in nuclear and investing in uranium.
Bitcoin is held above the $100,000 level ever since breaking through it. What do you see ahead for cryptos?
Yeah, well, Bitcoin, we've been saying all along here, Bitcoin has been really solid during all this tariff uncertainty. As you say, pushed up through the 100,000 and staying above there. We highlighted previously how Bitcoin was really starting to act more like the NASDAQ than gold. So, and it does. It's really been moving much like a risk asset, like a stock market, like the NASDAQ. So as you say, it's pushed through key resistance at 100,000. That is now strong support for Bitcoin. Again, it's been acting as a risk asset. So as long as there's risk on sentiment, Bitcoin should do well. We expect, though, that Bitcoin will become more of a safe haven play along with gold eventually. The other good thing for Bitcoin, we got China is wrapping up their stimulus. That's technically long-term going to be more inflationary. Yet another realization that with so much government debt globally, fiat currencies are dramatically losing purchasing power. And again, that's where we see that Bitcoin is going to become another alternative similar to gold. Now, giving Bitcoin, again, alternative to all these fiat currencies, for now, we see Bitcoin stay above 100,000. If it fails to do that, then the real key is that 92.5K, which was very key support for Bitcoin for months and months and months. So if it does get down to 92.5, I doubt it will go down much lower. That could be a good buying opportunity for anybody that missed the boat.
Can you remind our listeners about your DeFi Digest service?
So DeFi, decentralized finance. Again, just as a refresher, that's leveraging blockchain technology to deliver financial services without traditional intermediaries like banks. So again, they're built on decentralized networks. So things like Ethereum. And so again, to put that into context, it's like getting on the ground floor of a financial revolution, just like we saw back in Bitcoin, 12, 13 years ago. That's really the opportunity that DeFi represents today. It's not just a buzzword. It is a paradigm shift on how we are going to make financial transactions. It's a peer-to-peer financial services ecosystem. again, built on blockchain technology. And the key here is it's open to anyone with an internet connection. There's no paperwork. There's no middleman. And we've got, I think I said this on your show last time. You've got these big banks, these massive banks, J.P. Morgan, BlackRock, and these Eastern banks. They're forecasting that there's going to be $15 to $30 trillion market for real-world assets in the next 10 years. I mean, think about that. And we're talking about making digital transactions on a huge range of assets. I mean, it's endless, and it's expanding. So we're talking from corporate to government debt to real estate to fine art to commodities. I mean, we're talking from selling a tokenized warehouse where it's sold in pieces, where anybody in the world can buy a piece of it, to we've seen racehorses being bought where people buy a portion of that racehorse. And they own a piece of the puzzle. They own a piece of that asset. And if you go back, think about, remember streaming when Netflix came on board, how companies like Blockbusters went bankrupt. I'm pretty sure I said this last time. People go on online gambling and they go to these offshore sites and they have no idea how safe these sites are. How fair is this game? They're black boxes. You have no way of knowing how fair that game is. If you go on a DeFi platform, you would have a peer-to-peer betting using smart contracts, which would remove that centralized control, and that would allow players to bet against each other directly. And that's the real key here. No intermediary, no centralized control. So, it's a natural progression. We've already seen, who hasn't been in a Zoom call over the last 3 or 4 years? Who doesn't do online banking? Who doesn't do online stock trades? It's all driven by technology and convenience. Like I say, you got banking, you've got investing, you've got business meetings. We're moving from, transactions to, digital transactions now. And it's just the next natural step in this progression. So early adapters to the DeFi world, they're going to have this opportunity to capitalize on this shift, just like people saw when they got into the internet back in 2000 and got into Bitcoin, 15 years ago. But, I think it's really key, Jim, and the reason we're creating this DeFi Digest is there's going to be a learning curve. Just like, early Bitcoin investors had to learn how the new technology and all the tools. Well, DeFi investors are going to have to master tools like digital wallets, private keys, smart contracts, etc. But that's why we're creating the DeFi Digest. The newsletter is going to address all those challenges to educate and provide guidance to our subscribers and help them through the process. The learning curve exists, but if you've got listeners, if you're at home listening to this, and you're somebody that enjoys exploring new technologies and wants to be part of the next game-changing revolution, check out our DeFi Digest. Next issue will be out soon. If any of your listeners are interested, get on our list. Just send us a note at info@thetrendletter.com. So thetrendletter.com is all one word. We are not charging for this service, at least for the next number of months, but we do want people's feedback because we want to make this the go-to DeFi service. So again, if anybody's interested, just contact us, info@thetrendletter.com.
You've started a new Market Pulse service. What's that about?
Yeah. Well, one of the things that we do is anybody that signs up for our headline service, which is a free service, and that's where we give out news items, which we think all investors need to be aware of. Every morning, we scan what's going on in the news, and we send out information that we think they would need. But we also send out, or we were sending out, like every once in a while, we just send out market updates. We're just telling people, things we think people need to know. And we dive in. So what's happening in gold here, or what's happening with Bitcoin, or what's happening in the stock market, or particular stocks, things that we think people should know about. And we've been doing that for free. But I think what we're going to do is we're starting this new one called the Pulse, the Market Pulse. And again, what that's going to do is at least once a week, and more often than not, if there's more things going on, it'll be multiple times a week. We're going to send out this information, and it has charts, it's got information, and I think it's going to be. We've gotten such good feedback from these that we just want to make it an actual service. It will be included. It will include the headline service, and eventually we will charge for it. And it'll be a nominal fee, but right now it's going to be free. So again, if anybody's interested in that, they're welcome to send us a note at info@thetrendletter.com.
Can you remind us again about your specials and how listeners can support Heads Up Guys mental health service for men?
Yeah, okay. So the services, we have 6 services now, my God.
Wow.
I started this 24 years ago with the Trend Letter. That's a weekly service for long-term investors wanting to understand what's driving the market. So that covers equities, currencies, precious metals, commodities, and bonds. Then after the financial crisis, and where we had our Trend Letter subscribers who did not sell when we said to sell, and they said they lost all kinds of things. They just didn't want to sell. So we started the Trend Technical Trader originally as a hedging service, so that people could have insurance for when those big crashes happen, that they limit the losses and actually make some money. But we've now converted that into both a long and short service. So again, it's an online service. It updates every Monday, Wednesday, Friday, or, more often if there's something really important happening. Now that's for both active and long-term investors. And again, so that covers, most sectors, equities, precious metals, commodities. And it does include our proprietary gold technical indicator, which has been bang on picking trends for gold. We then started the Trend Disruptor service. So that's for speculators who wanted to get in on, the cool stuff, the disruptive technology. So we're talking AI, virtual, augmented reality, 5G, cloud, Internet of Things. So that comes out, about once a month. It really depends on what's going on. Sometimes it's more often, sometimes it's less. But that portfolio has done well, but it's volatile. So again, that's for money, capital that you can afford to lose. Again, we just talked about the new DeFi Digest. So we just went over that. We just talked about the Market Pulse and the headline service. So for those last 3, the Digest, the Market Pulse, or headlines, right now they're all free. If anybody wanted to get on those lists, just again, info@thetrendletter.com. And those special offers, basically, you've got 33% if you buy any one of our services. So that's the Trend Letter, Technical Trader, or Trend Disruptors. If you buy 2 of them, you'll get, so right now you'll get $200 off each of the single services. If you buy any 2, you'll get about between $600 and $650 off. So you'd be paying $600 instead of, so basically you'd be paying half price. And if you bought all 3, you'd save about $1,050, and you get all 3 of those for $800. And again, any questions about the market, any questions about our services, info@thetrendletter.com.
Martin, thank you so much for being on This Week in Money.
Oh, my pleasure as always, Jim. Have a great weekend. Enjoy the summer as it's coming up.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. He was speaking to us from Coquitlam, British Columbia. Coming up, Hilliard MacBeth, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the 2nd edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's still buzzing around MacBeth.McLeodPartners.com, and his website is MacBeth.McLeodPartners.com. He's speaking to us from Edmonton, perhaps the new home of the Stanley Cup this year. Welcome back to This Week in Money.
Nice to be back. Actually, I'm in Mexico right now.
Oh,
I
wow.
had trouble. I had to watch the game on my little tablet with a workaround with with Sportsnet with a VPN, pretending I'm in Toronto. But I managed to do it. It's a pretty exciting game.
What? Not every bar in Mexico is showing the Stanley Cup final.
Well, I'm surprised. Like I thought I went down there. It was like NBA this and NBA that and NFL, and I thought, what is going on? And soccer, of course, soccer.
Yeah. Well, I think Mexico only has like 5 or 6 hockey rinks, so maybe it's not the top sport.
No.
Now, the second edition of your book, When the Bubble Bursts, is on sale. Where can our listeners purchase it?
They can get the copy of the book at all the top bookstores, and also on the from the Amazon and Kobo versions, which a lot of people are reading in e-format, so they can get that as well. And it's actually 7 years since that book was published, but it's all of the stuff that is talked about in that book is now becoming more and more timely.
Yeah, is the Canadian housing bubble bursting right now?
I think it is. I hesitate to say that, but it all of the signs. So the peak was in 2022 in the Toronto being the biggest market, and the second biggest bubble, Vancouver being the biggest bubble. And Toronto has been sliding since 2022, and average prices are down. Depending on the part of Toronto, in the city of Toronto close in, they're only down about 10 to 15%, but in some of the suburbs, the decline is more like 25 to 30%. So it's happening. If you adjust for inflation, of course, there's been quite a high inflation rate during those years, so the numbers would be a lot bigger. So yes, and there's all kinds of anecdotal and actually hard data showing that people are starting to struggle with the debt. Of course, the book a lot of it was about the extreme household debt that Canadians had 7 years ago, and of course just gotten massively bigger since then.
What's the latest on Canadian home sales, inventory, and pricing?
So the inventory is huge. The sales are tiny, and prices have come down, but slowly. So what's happening is there's just a record number of listings in Toronto, Vancouver, and the prices have come down a little bit, but the buyers are frozen and the sellers are frozen. There's a big gap. It's a standoff. The buyers think prices should be down 35%, and the sellers think prices should only be down 5%. And that's I think in the case of the sellers, a lot of them, they don't want to sell below the amount of debt that they have. So if they've lost their down payment, I guess they're starting to come out of denial and be reluctantly accepting that maybe the best they can do is just get out of it with no cost. But if the price that they have to accept is below the cost of their mortgage, well, then they've got a big problem because they're going to owe the difference. And so that's what's stalling everything. So the sales, like the numbers for Vancouver just came out, and it was a 3-to-1 ratio. It says 3 times the number of listings as there are sales. For quite a while now, it's been 2 times, double, but now it's triple. So, and as you and I have talked about before, the sellers are very reluctant to move their prices down. The lenders, the people who lent them the money, will be the ones that force them to lower their prices, and usually it's done through foreclosure and power sale. In Ontario, it's called power sale. In other provinces, it's called foreclosure, but same thing.
As buying dries up, what are sellers likely to do? I
think they're just going to they're so reluctant to admit that they're going to lose money that they'll get stubborn, and they'll end up having a very, very nasty come to Jesus moment with the bank or with the lender, and that's not going to be fun. The people stay in denial because they've got in their head an idea of how things are going to work out, and losing money on that real estate project was not an option, and that isn't part of the plan that they had in their head. So very difficult for them to give up on that plan. I've been in that situation myself personally, and the stock market and other things, and it's just you grasp at every piece of news that bolsters your argument, and you ignore every piece of news that doesn't bolster it. So,
if you had to sell a home now, what would you do?
Well, it's tough because when you think about all the listings there are and all the people listening, they must be desperate people because they can see how many listings there are already. Why would they add their listing to the massive number of listings there already are unless they were desperate? So you have to stand out in some way, and I think that the best way to do that, unfortunately, the only way to do it really is to shock people with a lower price, and then the few buyers that are circling around will come and be interested. But I have heard secondhand from people that even when you do that, the buyers come in and they insult you with an even lower price. So it's really hard to get a transaction. So usually in these situations, there's been so few of them. You have to go back to the 1990s, 1980s. It was the bank that comes in, and the bank doesn't have any emotional attachment to any particular price. They just want to get it off their books, so they just say, "Well, just price it to sell," and that's what happens. So, if you're deciding to sell, you want to get ahead of that bank foreclosure flood of listings, because those prices will be terrible.
If you were selling a home, would you sell it yourself or use a realtor?
I think I'd use a realtor, because you want to give yourself every chance to get it sold. The problem with selling it yourself is, how do you get attention, right? So I think I'd use a realtor, and I understand some realtors are starting to charge for their time, because they get paid by commission, but if there's no sale, they don't get any commission, they don't get paid. So they're asking for an upfront kind of retainer in the case that it doesn't sell. So that tells you how difficult the market is right now.
What's the difference between a home builder and a developer, and what are they doing now?
Well, the developers, they got really wealthy in the last 40 years or so. Some of them I went to high school with, and I'm amazed at how wealthy they became. And what they do is they start up with raw land. Often, sometimes there's somebody in the family before them has started it, and then they carry on. And they sit on the land for 10 or 20 years, try and convince the city to change the zoning so it becomes possible to build on that land. And then a lot of times the developer will put in the streets, the sewers, the water lines, all the upgrades that the land needs to be ready to build houses. And but they won't build the houses themselves. Then they'll bring in the home builders. And a lot of times the developers insist that the home builders commit to a certain minimum number of lots before they can build a house. But there's all kinds of special deals made between the home builders and the developers. But the developers are the ones that have done really. Actually, in Alberta, where I live, the home builders have done really well also. And there's some crossover with the home developers. Some of the developers have gotten into. They've seen how much money the home builders are making, so they decided to get into home building themselves. But that's sort of the demarcation there.
This week, the Bank of Canada left the central bank rate unchanged, but what's happening with mortgage rates?
Yeah, so mortgage rates don't go by the Bank of Canada rate. The Bank of Canada rate actually usually is often following the market rather than leading it. Many studies have shown that the Bank of Canada, the central bank rates all over the world are not. They don't influence the market. They reflect where the market is already heading. And what's been happening is the government bond rates in the U.S., because people are starting to be worried about the budget deficit, have been rising, and the 5-year government bond rate, which is where the mortgage interest rate is usually priced off of, has not been coming down. In fact, it's gone up a little bit. So that's what will influence the mortgage interest rate that people will look at. And apparently, although I've seen so many different numbers, and I don't know the data myself directly, but apparently in the next 18 months, something like more than half, maybe as many as 60% of Canadian mortgages will be renewed, and the majority of those will be renewed at a much higher rate than it was 3 to 5 years ago. So that's a crisis waiting to happen. The government, I don't know if the government, of course the government's brand new, I don't know if they realize the enormity of what's happening, or if the Bank of Canada is waiting to do a shocking, they might delay and then shock the market with a really big rate cut, but they would only do that in the case where it's confirmed that we're in a recession, which I suspect we probably already are in both Canada and the U.S. But there's all kinds of conflicting information about that. But so when a recession is actually confirmed, then the Bank of Canada rate will do a big rate cut. But then that shows you that demonstrates right there that the Bank of Canada follows the market, doesn't lead the market.
The U.S. stock markets are continuing to move higher. What do you see ahead for those markets?
So the market, the stock market is come up close to its record high, which is around 6,100. The S&P 500 is the one that I follow the most closely, we got down to 4,900, so it was off 20% at one point, not that long ago. And I think around the time that the tariff man went crazy with tariffs, and then we've had a rally since then because the market is looking at the president of the United States backpedaling on those tariffs. So they've been a rally up from 4,900 to about 5,900 within less than 10%, probably less than 5% of the high that was reached in the last 12 months or so. So I think probably we're going to see a move lower again because the damage that the tariffs are doing. He hasn't completely backpedaled on the tariffs, and and he's putting new tariffs on. This week he put on a 50% tariff on steel and aluminum, which is just devastating to lots of countries, including Canada. And we haven't really seen the devastation that those tariffs are causing, but it's pretty substantial, I suspect. So we'll see in the next few months. The data comes out late, so we don't have the information until the damage has already been done. And now Trump is sort of looking like he's not as popular as he was before. There seems to be a drop in popularity with Trump, and then this latest spat between Elon Musk and Trump won't help it either. They're both shouting accusations at each other on X and other social media. So the stock market, but even without all of that, the stock market is extremely expensive, and every time that it's gotten this expensive, there's been a pretty big correction. The biggest one of all was Japan in 1989, and the second biggest one was 1999, 2000 in the U.S. stock market with the internet stocks and the dot-com stocks. This bubble currently is already bigger than the 1999-2000 bubble, bigger than the 1929 bubble, but it's not as big as the Japan 1989 bubble. But they all do burst eventually, and that's probably coming in the next recession, whenever that happens. My guess is the recession's happening pretty soon.
The TSX Composite Index continues to hit new all-time highs. What's causing this?
Yeah, it's hard to know with the TSX. I barely watch it anymore. It's if you look at if you wanted to look at the TSX, just look at go on a search engine to say what are the 20 biggest stocks in the U.S. stock, the Canadian stock market, and you've got the banks, of course. You've got a couple of pipeline companies. You've got a few oil companies, and you've got BCE Telecommunications and Rogers and a couple others. There's not a lot of, and there are some tech stocks. There's Constellation and another one that's sort of like an Amazon, but Shopify, I think it's called. So there's not a lot in there that is like really a must own. There's no AI in there, for example, or anything like that. Which is what's caused this surge lately in the U.S. stock market. Is everybody's the hype around AI. So I think it's probably the Canada might be viewed as a safer place than the U.S., which is interesting, but may or may not be true. But there may be some money. There has been some money being pulled out of the U.S. Due to all of the, when the rating got changed, the AAA rating was changed, was lost. Not the first time. It happened in 2011 with one of the rating agencies. Now another one has done it just last month. I mean, so. There may be some money shifting into, because Canada still has a AAA rating and Germany still has a AAA rating. So those are the only two large market countries with AAA rating. And I don't suppose Canada will keep it much longer either. So I don't know about Germany. So that may be it. It may be safe havens, or it may just be there's a bunch of Canadian institutional investors that have to invest in Canadian stocks for whatever reason. So they're keeping it propped up.
The TSX Venture Exchange is at the highest it's been since May of 2022. Could 2025 be a sell in May and go away year for the juniors? So
the juniors on the TSX Venture that are leading this thing are probably the gold juniors. So I've been the gold bug since, not a bug, but I mean, I've been interested in gold since I started in 1978. And in 1980, the gold price hit $850 an ounce, which was the high. It come up from $100 roughly or something like that. And it was that day that the TV cameras came to my office and they interviewed me, and I was sitting in the big bullpen where, you see on the movies about Wall Street, you got the people all lined up in desks and shouting, and they got their phone to their ear trying to get some sales, and that's what it was like. And they came in and interviewed me, and they asked me about this gold. People were lined up to sell their gold jewelry and stuff to get cash in this $850. Well, the gold price just hit the equivalent. So the equivalent of $850 with inflation, adjusted for inflation, is $3,300, which is exactly where the gold price is now. So the gold price now has moved up a lot in the last couple of years, really since 2009. And there's a lot of junior gold mining companies on the TSX Venture Exchange. So that's what's happening. So if you want to know if it's going to last, if you should sell and get out, or whether you should stay in, you have to be able to predict the price of gold and whether this gold mania is going to continue. So my view is that it's not over yet, because the Bitcoin mania is still more important than the gold mania. The gold mania is pretty mild compared to cryptocurrencies and Bitcoin and all that. So it's only old people like me that are still got the gold bug. And for young people to get involved in the speculation in gold mining companies is still yet to come, if it ever comes. But given the profits that are being made, so the all-in cost for mining gold right now, they've crept up from $1,000 all in to about $1,300, $1,400, but at $3,300 sales, $1,400 cost, the profit margin is huge. So there's going to be a lot of money flooding into the gold market, and some of those juniors have real prospects, and other ones are just speculations. But it's kind of hard to tell which is which.
The U.S. dollar continues to trade near lows not seen since mid-2022. Are you bullish or bearish on the U.S. dollar?
Well, it's hard to predict currencies. I'm not any good at it. I predict on your show a few months ago that when the Canadian dollar got down to 69 cents, it would probably go to 65 cents. And now it's up to 73 cents. So I'm probably not the right person to be asked. I don't think anybody seems to be very good at predicting currencies. But the whole thing hinges on whether usually the U.S. dollar is a safe haven a minute ago we were talking about stock market correction coming and a recession in the U.S., a recession in Canada. Well, when that happens, there'll be a lot of stress, and there'll be a lot of big companies going bankrupt and stuff like that. And usually the U.S. dollar does really well in those cases because people view it as the safe haven. And now people are doubting it. With all of the speculation and the loss of the AAA rating and all that kind of stuff, people are doubting whether the U.S. is the safe haven. My bet is that it'll still be the safe haven for a little while longer, and it's not, hasn't really come down that much. It's come down 10% or whatever, but it's not a big deal. It's probably going to be viewed as still a safe haven to some degree. Gold would be viewed also as a safe haven, but you can't really store billions of dollars in gold very easily, so it's easier just to put your money into U.S. Treasury bills. Warren Buffett has a third of all of his, $1 trillion company, Berkshire Hathaway, in U.S. Treasury bills. Last one was $340 billion in Treasury bills, which is an amazing thing to think about. A guy that just loves the stock market. He's 94 years old, but he loves the stock market, and here he is sitting on a pile of U.S. government Treasury bills. So that's a bet on the dollar, and it's also a bet that the market's going to come down so he can buy stocks more cheaply.
Canadian dollar rebounding since February. Are you bullish on the Canuck buck?
No, I'm not, because I already clarified what a terrible predictor I am of the direction, but 73 cents seems way too high to me, given the coming bursting of the real estate bubble. The real estate bubble is much bigger than people realize in Canada. I don't think the people in the U.S. and Europe and China and elsewhere really have a sense of how big it is. Most Canadians don't have a sense of how big it is, and people don't understand how big the debt is. And if they read my book, they'll understand it. But unfortunately, most people haven't read my book. So when you and I wouldn't have known it if I hadn't read the book. When you actually get into it and realize how big the value of real estate in Canada is, and how much debt is tied to it, how much the real estate is collateral for how much debt. I couldn't be bullish on the Canadian dollar. No, when when people start realizing it, and they see more foreclosures and power of sales and big commercial projects. Like big commercial projects are already starting to go under. Vancouver's got a couple of big condo developers that are probably on the edge. Toronto's got many condo developers that are already in deep trouble. The lenders have lent to those people. They've either lent to the developers themselves or they've lent to the people that agreed to buy the condos in those developments. In any case, that will cause the Canadian dollar to come down when that gets. There's no understanding of that in the international markets yet, but when there is, then the Canadian dollar will struggle.
Gold is trading close to all-time highs. Where do you see gold going from here?
Gold's gone up a lot, as I mentioned earlier. It's at $3,300, which is the highest price adjusted for inflation since 1980, and the highest price ever, equal to the highest price ever. But it's a way of hedging against the U.S. dollar. So when we say gold is $3,300 an ounce, we're basically saying the U.S. dollar has dropped from 1 over 3,300, dropped to 1 over 3,300 from say 1 over 850. So it's basically lost its value in line with inflation. But if you're worried about the U.S. dollar, gold is a good hedge. Unlike crypto, which is not a hedge against anything. Crypto's not useful for a store of value. Crypto's not useful as a medium of exchange. Gold is a store of value. You can use it. It's a little bit clumsy and cumbersome, but you can actually use gold as a medium of exchange if you have to. So gold's got the advantage of that. So it's a hedge, and it'll probably get more popular as a hedge when people find that cryptocurrencies are failing them.
Silver is showing strength. Where do you see silver going from here?
So silver always has a run when gold has a run. It's like the poor man's gold, if you like. And but the difference with silver is it doesn't have the magical cachet that gold has in terms of a store of value. So silver tends to go up and down with the speculators, and it has a lot of industrial uses. And for instance, the solar panels, all over the world except for the U.S. and Canada, the installation of solar panels is absolutely booming. And because China has brought the price down 95% of a solar panel, people can afford to buy them all over the world except in the U.S. and Canada. And there's some silver that goes into the solar panels, so they use silver. They use silver in a lot of things, the computer chips, that sort of thing. So it's quite a useful thing, but it tends to trade more as a commodity rather than a speculative store of value. I mean, central banks worldwide hold gold, and trillions of dollars worth of gold in their vaults, right? But they don't hold silver in their vaults. So silver doesn't have that built-in demand as a store of value like gold does.
Canada's Prime Minister Mark Carney has announced $486 billion in new spending, but not what it's for. There's no budget. Should we be concerned?
Well, you can worry about government spending. It's like it always seems to go up, and the debt always seems to get bigger, and somehow we muddle through. So I'm not in the crowd that's yelling, "Oh, the government's going to collapse under the debt." But because the thing is, not all governments, but governments like the U.S., Canada, governments in Europe, Chinese government, Japanese government, they can print their own currency, right? So if they decide they're going to spend now that number's over 10 years, that isn't like every year, but they can print their own currency as long as people are willing to accept the currency. They'll be okay. Now, if it's Argentina, people they didn't want to accept the Argentina peso, so they wanted only U.S. dollars. So that created a currency crisis and a government debt crisis. But I don't think that's happening in Canada, the U.S. Right now. So the debt will be okay. Now, one of the things that with spending, Canada's way under the 2% goal for NATO spending at 1.37% of GDP. And now the new number is 5%, and Canada's talking about joining a European defense coalition outside of NATO. It looks like NATO may be kind of yesterday's news. So they'll probably be forced to increase their military spending a lot. So that would be a tripling of the defense spending, which is many tens of billions of dollars. So that could be where some of the money is going to go. And then he's talked about energy projects, and he's talked about a bunch of other stuff. But I guess we'll know soon enough what they're going to spend that money on. I hope it's not on real estate because, I hope it goes into something more productive than real estate. I think, my opinion has been Canada's problem the last 20 years of investing too much in real estate, which isn't really a productive asset, and instead of investing in more productive things like, building electric cars or building, there has been some investment in fossil fuel energy projects, a lot actually. They spent $35 billion in the pipeline to the West Coast, which is productive because you get the oil out and somebody needs it and they buy it. But there's a lot of things that need to be done. Huge upgrades to the electrical grid, for example. That would be a very interesting and useful, productive expenditure. So I'm hoping that's what they decide to spend. So the spending of the money isn't the issue. It's how you spend it. That's the most important part of it.
What are you hearing on the push for Alberta independence?
I saw on Twitter, or on X, somebody mocked up a Alberta passport. It's a Republic of Alberta, it says at the top, and then it's got a Alberta flag on it and stuff. I didn't think it looked that good, really, and the problem with independence for Alberta is there are many, many problems with it. First of all, I don't think the public supports it. Most of my friends at the golf course are very right-wing. None of them are supporting it. Well, maybe, actually, no, that's not true. A couple of them are supporting it, but I would say 8 out of 10 are not supporting it. The middle of the road people aren't supporting it, and so it's not a widespread movement by any means. And what is it? What does Alberta gain? So imagine trying to get that pipeline project built to the West Coast. If Alberta was an independent country, it would be much, much more difficult to negotiate with Ottawa and with BC. The same, maybe it'd be easier to negotiate with the U.S., but there isn't that much the U.S. can do for us. And south of Alberta is Montana, and there's not very many people there. There's not a whole lot you can do in trading with Montana. So it's the U.S. doesn't need our oil that badly. They've got oil. They're the largest producer in the world by far, 13 million barrels a day. Alberta's big too. Alberta's over 4 million barrels a day, and we send almost all of it to the U.S. But Alberta would struggle. I think that would be a big mistake.
Do you think Canada is destined to split up?
Well, if Alberta goes independent, for sure, I think it'll split up, because then Quebec would go independent, and then, what are you going to do? But so the only way that Canada can survive as a separate nation is to remain together and independent of the United States, and that's going to be hard because we're so closely tied to the U.S. and there's many, many ways the U.S. can hurt us really badly if they get really mad at us. So it's going to be a tough few decades coming up. The population growth, which is causing a lot of problems right now, is probably something that's necessary, though, because we got a very big country with a very small population. So if we could grow to maybe double our size, 80 million or something comparable to Germany or France or whatever, that would help. But we've got a very large territory and a very small population, so that makes it harder to defend and also hard to hang on to. But on the other hand, nobody wants to live up north, and there's polar bears there. So, if my American friends, when that all that talk 51st state came up, I said, well, we have polar bears up north, and they like to eat people. So be careful. Be careful about trying to invade Canada. So they didn't laugh, but I thought it was pretty funny.
Cadillac's released its new flagship for 2025, an electric vehicle called the Celestiq. It's a 4-door hatchback with 4-wheel steering and the wheelbase of a Chevy Suburban. It retails for $340,000 US. Could that be your next EV?
I don't think so. I can't. First of all, that's too much money. for me to spend, and then I'd be worried that, first and secondly, it's not in production yet. I don't really trust Cadillac, GM. I don't trust GM to follow through on it. And if you buy one and then they decide to cancel it, like they've canceled so many other electric cars, then you're stuck with something that's just kind of orphaned. You also have to think about charging. What are you going to get access to the charging network the Tesla has? So there's a lot of problems with it, but the price tag is way too high. I think it's a marketing gimmick. That Ford F-50 Lightning, for example, the pickup truck, everybody got really excited about that. People were flocking to the showrooms. They wanted to see it because they loved the idea of being able to charge their power tools out of the back of the Lightning. But when they got to the showroom and talked to one guy that told me this, said they wanted $130,000, $140,000 for the F-150 Lightning, but then they offered him the same vehicle for $75,000, $80,000 in the gasoline version. So he took the cheaper version. So it might just be something that they're trying to get people into the showrooms and then bait and switch them. I don't know, but there's some very interesting cars coming out of China. I can't imagine buying a Chinese car, but BYD has got some, and some other ones have got some offerings that are just spectacular and really advanced cars, very fast like my Tesla, and much cheaper. So that's probably that's the future. Not GM with a $340,000 electric car. It's just hilarious, actually.
Where can people follow you, and where can they buy your book?
So I'm on X, formerly known as Twitter, under HMACBE, and I'm on Blue Sky, although I don't post that much there. And they can buy it, as we said, they can buy the book in all the top bookstores, plus on the Kindle and Kobo and all those other options. So, hope to connect with people, and we'll be watching closely for the bursting of the Canadian housing bubble.
Hilliard, thank you so much for being on This Week in Money.
Nice to be here.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, Martin Straith, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.